We are facing an unprecedented crisis. The impact of the COVID-19 global pandemic on the global economy and the equipment finance industry is only beginning to unfold. And so far, the unfolding has been both fluid and dynamic. The companies in our industry face numerous challenges, and many are using the constraints of social distancing to innovate and create. In these uncertain times, Monitor's Coronavirus podcast series will provide real-time conversations with our editorial board members about this evolving global event. I'm here today with two members of Monitor's editorial board, Vince Belcastro, Group Head of Syndications at Element Fleet Management, and Chris Enbaum, CEO of AP Equipment Financing and Work Truck Direct. Vince and Chris, how are you seeing the coronavirus impact the industry and your companies?
Oh boy. Well, this is Chris Enbaum. This is all just literally unfolding, almost as we speak. And we had an editorial board call with Vince and myself and all your other editorial board members just 2 days ago. And at that point, I think, the severity of this crisis was just starting to unfold within the last 48 hours. The facts of the situation have changed dramatically. The stock market is, way down. The liquidity issues in the market are starting to be apparent. The government's had to intervene with all kinds of liquidity measures. And I think that the reality of the situation to American citizens has really started to take hold, that this is very severe, and it's impacting everybody's lives. And, you're already starting to see layoffs and things like that, even from 2 days ago. So I think that's the background, obviously, from a general economic perspective. And, I'm sitting here literally in lockdown, being enforced by law in the Bay Area, where, we've kind of, I think we have it pretty severe. Things are literally shut down except for essential businesses. And I think you're going to see that continue. In fact, probably all jurisdictions within the next few days, I think, are going to be literally shut down by law. I think it's going to continue to get more severe because there's certain areas where the hospitals are already starting to get overwhelmed, and we have all kinds of issues with getting health care to the people who happen to get severely ill from this. And so that's the reality has changed very quickly.
I'll take this as a two-pronged approach. This is Vince Belcastro here. So, it's evident, certainly it's evident in the capital markets, to belay Chris's comments. While the banks for the time being and some of our trading partners that purchase our debt continue to remain open and they continue to fund transactions, I think that it's fair to say a lot of institutions have imposed floors and so forth in regards to required returns. So based on when those transactions were priced and certainly whether fixed rate, that certainly is something that's going to impact economics. And then secondly, the concern becomes, as quite frankly, for the smaller banks, as some of their clients draw down credit lines and hoard capital, as is happening all over the globe, then that really does begin to dry up liquidity in the capital markets, and how that affects loan trading and loan sales and lease sales is something that is anyone's guess. And then furthermore, look, it's early in the game to, exact thoughts, but you can see where the stress on local businesses, smaller local businesses beginning, and then quite frankly, the longer this goes on, the more that will be pronounced as collections sort of are challenged. And then furthermore, it certainly will trickle up as larger companies are certainly taking measures, whether it's Big Auto, who's announced major cutbacks in production or possible stoppages, et cetera. We're only in the early games of feeling the full ramifications of this effect.
Yeah, no, Vince, I think that's exactly right. We're seeing the same things. We started getting calls a few days ago, kind of the end of last week, from our clients who are mostly small businesses requesting payment relief. What we find is that the companies who are earliest in requesting payment relief tend to be actually the most prepared customers. I mean, we went through this in 09, 10, and so we generally will, within pretty broad parameters, approve payment relief to pretty much anybody who has logic, to allow it at this point with cash flow. And then generally we're kind of putting things into two categories. One is, lower risk for long-term default due to, changes in long-term customer behavior. So for example, people who are like plumbers or, people that perform kind of essential services, we know that there's a higher likelihood that, they're going to be back to more or less normal at some point. And then there's people who, like restaurants and or other businesses that, may or may not be able to survive this, because our thought is that if you read a lot, like what's happening in China right now, for example, who already has been through this, and then you start getting second waves of the virus, there's probably going to be longer term social impacts from this and disruptions. And most people believe that this, once we get through the initial kind of quarantine time, which will probably be at least 2 months is my guess. After that, you'll probably have, things kind of come back slowly, but you're going to have other pockets of this virus coming back. It's most people are going to get it, within the next 2 years. They're just trying to slow it down because, but you're going to have it continue to pop up. So there's long-term effects from all that. So we try to evaluate, with the businesses, which ones are, probably going to make it and which ones aren't, in very general terms.
Well, yeah, I certainly agree. Look, as I mentioned earlier, it's hard to find in the general New York City area and the metropolitan area. It's hard to find full service restaurants that are open, and that certainly impacts all their suppliers. Whether it's food suppliers or hard goods suppliers or everything else, and the payment disruption certainly is extreme in those particular cases. But you think about that even in regards to a flagging retail industry, that's already under intense pressure from online retailing. That will continue to, suffer major challenges, and presumably brick and mortar will be harder hit than even online. In fact, Amazon is obviously struggling to keep up with basic goods orders. They've announced hiring another 100,000 people. Which is all well and good, but it does impact brick and mortar all around even more. So,
Yeah, no, I agree. And so, things that we've done with our company already was we've already started to shift some people into collections and customer service. We've already started to change up some of our sales staff into areas where there is actually created more demand. We are in some areas that are actually experiencing huge demand, kind of luckily. And then other areas that are, where the demand is really going to fall off the cliff for a while, there's kind of taking them off of that. And then, you always have to look at, your overall cost structure, going forward. I mean, everybody who's been through this before, I mean, one of the mistakes we made last time around in that last recession was probably, not right-sizing costs, quickly enough. There's definitely going to be a recession here. And so, it's just a question of making sure that you're right-sizing correctly. And hopefully we won't have to do too much, but, you have to be very realistic about it. There's going to be a lot of dislocation of companies. I mean, there's companies that have the wrong mix of assets right now. And unfortunately, some of that's just bad luck. They're going to be under severe stress. And so we've already started, we're working with a partner that we did in the last recession to put out the shingle to buy portfolios and assets and companies again. as we did 10 years ago. So there's always opportunity. But unfortunately, the opportunity comes with, there's going to be some more losers than winners. Unfortunately, the recessions never are good overall.
Yeah, I certainly agree with your comments, Chris. The question becomes, if you're going to be a buyer under these times of presumably distressed portfolios and in some cases assets, the question is, will capital markets liquidity hold up to enable those trades? Unless you're cash rich, then, there is presumably a situation where you wonder whether companies capital providers, whether it's banks or funds or anyone else, and typically the trades you're talking about here get funded by non-bank solutions, will they sort of look at this and say, wait, time to pull back and watch the markets and settle in before we, rush to, invest in capital opportunities where the discount factor may not have reached its peak yet?
Yeah, no, I think, there's going to be a couple of repricings here and, this will play out over the next year or more. If we look at the 2008, 09, the market crashed in September of 08. We started buying assets about 9 months later. By that time, the markets had fully kind of repriced, meaning that, people knew, kind of understood the value of the assets. Presumably there was still not a lot of liquidity. And I think, that could happen here. Like you said, there's probably going to be, some liquidity issues, but, this time, at least people don't seem to be as levered as they were before. I mean, the last crash was caused partly by leverage. This crash is caused by a virus, and regulations have kept leverage pretty well under check. Most independent finance companies, going into the last recession, we were 7-to-1 levered. Right now, we're 4-to-1 levered. And I think, probably will go down to maybe 3-to-1, which is a very safe level. But, I think that the leverage situation helps the liquidity situation. For independents, there's just not as many independents left. So, a lot of this is going to be trades between banks but there are hedge fund and other pension assets out there that are willing to buy distressed assets. And so I'm sure there'll be buyers again within the next few months.
Yeah. I don't disagree. I think, again, it's just a matter of, have we priced in the full spectrum of distress yet? And, who knows? It's too early to tell, and it's anyone's guess, right? So. Yeah.
And that's not the primary concern of most people. It's, really, it's, just getting through this, obviously. Whether you're a finance, running an independent finance company, whether you're working for a company, whether you're running a bank, whether you're running a captive, you're facing the same issues in different forms. And, the number one issue is trying to assess, where you're at, make sure that you can, work with customers who are willing to work with you, get them through this to the extent possible. Part of this will be temporary, and then there'll be the second part, which is the more permanent part. And like you said, assessing what the permanent risk is going to be and what parts of the economy are really going to be destroyed versus the ones that are just going to kind of come back. I mean, that's the part that is going to have to unfold over, for the rest of the year.
Yeah, well, it's hard. Look, you'd be hard pressed. The obvious is, look, consumer durables, I have to think in the short term, Chris, it's kind of hard to see how, those markets sustain themselves, whether it's autos or class, the heavier duty trucks. I mean, we already went through such a big replacement cycle over the last 7-8 years. Class A trucks were already starting to trend down. So it's hard to imagine where, quite frankly, even if that capacity is absorbed by, even if that capacity is absorbed by online retailers needing to make more deliveries and hiring more third-party truckers, quite frankly, it's hard to see where, companies really sort of sign up for increased new truck demand. And as we've seen in the past, and this is probably a good point to sort of think about, managing cash flow. Obviously companies will start to keep fleets on the road even longer and take advantage of the economics of keeping their payments lower. So, that exacerbates the whole finance scheme, whether it's trucks against loans against moving assets, leases against moving assets, or other type of ancillary stock that, goes into delivering goods and services to some degree. Low oil prices will certainly potentially affect the shipping industry. I mean, we haven't talked about the effects of, quite frankly, historically, low oil prices and its effect on those industries that are heavily related to oil, whether it's, brown water shipping, movement of energy up and down our rivers, exports of Canadian energy. I mean, Canada and the U.S. have agreed to shut down borders for only the most essential travel. I mean, that's significant. So the widespread effect of this is just so early to tell, and it's so broad-based. That's the difference with this one. And it's not to say that 2008 wasn't broad-based, but that was really driven mostly by the financial markets. This is so much more broad-based.
Mm-hmm. Yeah, no, I agree. I think it's going to be pretty scary, and I think the government is going to play a bigger role, not just in stabilizing financial markets as they've been doing over the last few days, but also in providing stimulus. I think I believe they actually made a mistake by lowering as much as they did, because lowering rates in a time where there's no demand doesn't make any difference. What they needed was a fiscal response, which they're working on as we speak. But my guess is that, this is just going to be the start. The government's going to have to take a very active role in trying to figure out how to prop up businesses and people, over the next 6 months or so to keep this from becoming even more of a disaster than it's looking to be.
No, I agree with you. I don't disagree on the rate situation, because that has limited effect. Now, oddly enough, that's a situation where quite frankly, over the last 4 days, even after the last rate cut announcement to near zero, interestingly enough, the short-term rates and the long-term rates have sort of not come down as much as one would have expected. They're hovering in that 3-year average is hovering in that 60 basis point, sort of spread environment, which I find interesting. And I think conversations with most bankers and financial executives in our industry seem to point to the fact that, everyone seems to believe that it just hasn't caught up yet. And so it'll be interesting to see what happens over the ensuing weeks and whether rate economics, base rate economics actually hold up. And the same can be said about LIBOR. All interesting parameters we should watch.
The last rate cut really didn't change it.
Yeah. So which was the first time I've certainly witnessed that. And I think that safe to say we're all witnessing situations that we haven't seen. Even in 08, if you remember the 08-09 crisis, as much as there was many pain points across asset values, loan values, and so forth and so on, what we really didn't witness is such a huge, decline in base rate in such a short period of time.
Yeah, it's interesting because we're, as an independent now, our funding cost is much, much closer to banks than ever. Banks are all had been scrambling for deposits. Now that may be changing as we speak, as companies are starting to hoard cash. And I don't know if that's going to only kind of go to the biggest banks, because it's people like United Airlines who are drawing down, billion-dollar lines, or if it's going to be small companies as well who are actually, putting deposits into banks. My guess is that it's going to really help the bigger banks a lot more than the smaller ones. But, it does have an impact on competitiveness in the market, because we feel like we're as competitive with banks as we've ever been in this particular environment, which, to the extent that our liquidity continues, which we'll see, because we both have our own revolvers, things like that, but then we also sell transactions into the market. So that gets to, what's the market going to buy? And your point at the beginning of this conversation in terms of people are still funding right now. We're actually selling portfolios as we speak, but, when is that, how long is that going to hold up, under what situations, what assets are going to be, kind of illiquid in another month, and which ones are, going to continue to trade. All that stuff is kind of unknown at this point.
Yeah, I fully agree. And I think that, once again, the situation in 6 months, 3 months, 6 months, whatever handle you want to put on it, when it ultimately does begin to catch up, quite frankly, you're hard pressed to figure out where this, I think we're already there as far as recessions go, but default rates, let's focus on that for a minute. Default rates will certainly, be significantly higher. And so the question is, with default rates significantly higher and with these massive drawdowns by large companies across their bank groups, does that cause a liquidity crunch where, quite frankly, it causes our trading partners who are buy our loans and leases and so forth and so on to either begin to shut down and or, quite frankly, divert their attention to just funding their own clients versus buying wholesale paper?
Yeah. Well, time will tell, and I look forward to actually listening to other podcasters on this series to see what happens as we go forward, because I'm sure things in another week will have a little bit of a different flavor, or maybe a lot of a different flavor, but it's interesting times.
Very interesting times. And in fact, even, on that note, when, focusing more on credit quality, a lot of the players that generally go to, light double B, single B players, they have to and already are taking a much harder look at the balance sheets of the companies they're financing, the assets they're buying, and the advance values. And look, that's rightfully so. Those are the markets where the industry dependent, you have to be cautious in. Does that begin to make trading out of those transactions even harder? And on the front side, for the banks on the front side, look, the risk premium in pricing due to outstanding commitments and outstanding, transactions, whether you're a bank financing clients that's got forward commitments, or fleet companies that make a living financing fleets, and people like Caterpillar Financial and some of the folks and some of the captives that, quite frankly, normally treat financing as a service to their clients. They really have to look at rates across their tranches, their credit grade tranches, right? So you can see a scenario where, despite the lower rates, the risk premiums will have to go up, right? So.
Yeah, I was talking to actually a hedge fund about this a couple of days ago, and our projection was that the really good credits, even with small companies that are in industries that are going to continue to do well. And there's a few that will, they will continue to trade at a very, low margin, but because those are always going to be in high demand, everybody's going to look for quality assets. But anything that's not, just a perfect asset in whatever size class you're talking about, those are going to get totally repriced, like you said, all up and down the credit spectrum.
Yeah.
So that part, it's going to get harder to do those tougher deals. It's going to be harder for those companies to get lending or find people to lend to them, and the pricing is going to change. So that. And if you have portfolios that have those assets, they're going to be illiquid, pretty much.
Yeah. Yeah, and we haven't even touched on, again, too early to tell, what the effect of this is on the securitization markets for the active issuers. Hopefully those continue to remain viable sources of capital. That said, once again, what does the risk premium become on issuing securitizations in those markets? Because you have to envision a scenario where it just kind of gets more expensive, right?
Oh yeah, and I think for now there's probably not much going on. The next few months, I can't imagine anything's going to happen.
Yeah,
I think the markets are kind of going to be shut down for quite a while until we all figure out what the new normal is.
Words of advice that you two have for the companies out there?
Oh boy. I guess my only 2 cents is, read the news. I mean, read all the news and try to make projections based on hard facts about, we've already been through this in other countries to a certain extent. We can see trends there. There's information out there about how to handle these types of crises. But it's going to, I think the companies that are really forward thinking and really prepared and make really good, valid assumptions, even if they're changing every day about what the future is going to be, are going to be the best prepared to get through the situation. I mean, people who put their head in the sand are dust. They're not going to make it.
All right. Thanks so much, Chris and Vince. I appreciate your time. And thanks to everybody listening. Bye.
Thank you.